Topic focuses on tail risk through the analysis of major hedge fund collapses, trading failures, and financial frauds. The topic emphasizes that extreme market events often expose hidden weaknesses in leverage, liquidity management, risk models, and governance structures. Tail risk refers to the possibility of severe losses arising from low probability but highly disruptive market outcomes. The program examines several historical failures involving hedge funds, quantitative trading firms, and fraudulent investment operations to demonstrate how behavioral biases, leverage, and weak controls can magnify financial losses. Understanding these events helps investors improve due diligence, risk management practices, stress testing, and governance oversight within alternative investment portfolios. The topic first examines risks driven by market losses through cases such as Amaranth Advisors, Long-Term Capital Management, LTCM, and Carlyle Capital Corporation. These firms relied heavily on leverage and concentrated trading positions to generate enhanced returns. Amaranth Advisors collapsed after making large directional bets on natural gas futures using a calendar spread strategy that became excessively concentrated and volatile. LTCM similarly relied on leverage and convergence trading strategies that failed during periods of market dislocation. Carlyle Capital suffered severe losses because highly leveraged mortgage-related investments became unstable during the global financial crisis. The program stresses that leverage magnifies both gains and losses, particularly when declining investment opportunities encourage increasingly aggressive risk-taking behavior. Behavioral biases and excessive confidence are also identified as major contributors to tail risk events. Many failed funds believed market relationships would revert to historical norms, underestimating the possibility of structural market changes. Managers often ignored warning signs because prior success reinforced overconfidence and encouraged larger risk exposures. The program explains that behavioral biases can distort risk perception, particularly when investors rely heavily on quantitative models or historical correlations that may fail during crises. The topic also discusses volatility of volatility derivatives and the dangers of assuming stable volatility conditions in stressed environments. Effective risk management, therefore, requires recognizing that extreme events may invalidate traditional assumptions and that models alone cannot eliminate uncertainty in complex financial systems. The program further analyzes the impact of trading technologies on financial crises through events such as the Knight Capital collapse and the 2007 quantitative trading meltdown. Knight Capital experienced catastrophic losses after deploying defective trading software that generated millions of erroneous orders within a single trading day. The incident demonstrated how automated systems, high-frequency trading, and algorithmic strategies can amplify market instability when controls fail. Regulators subsequently emphasized the importance of pre-trade controls, testing procedures, and operational safeguards. The topic explains that technological advancements have increased trading speed and market efficiency, but they have also introduced operational and systemic risks capable of creating rapid and widespread financial disruption when combined with leverage and illiquidity. The topic also explores major failures caused by fraud, including Bayou Management, Bernie Madoff, Lancer Group, and Theranos. Bayou concealed losses through fabricated financial statements and a fictitious auditing firm, while Madoff operated a large Ponzi scheme disguised as a legitimate investment strategy. Theranos misrepresented technological capabilities and deceived investors regarding the effectiveness of its medical testing products. These cases illustrate how weak governance, inadequate due diligence, conflicts of interest, and insufficient transparency can enable fraudulent behavior for extended periods. The program emphasizes that investors must conduct thorough background checks, require independent audits, verify operational controls, and develop expertise in underlying business models to reduce exposure to fraudulent investment opportunities. The topic concludes with 4 major lessons drawn from the analysis of fund failures and tail risk events. First, leverage can generate extraordinary returns, but also catastrophic losses when market conditions deteriorate. Second, overconfidence and reliance on historical relationships may prevent managers from recognizing structural changes in financial markets. Third, predicting every risk is impossible, making continuous monitoring, stress testing, and robust risk controls essential. Fourth, the large fees and prestige associated with alternative investments attract both highly talented professionals and fraudulent actors, increasing the importance of operational due diligence and governance oversight. Overall, the program stresses that effective risk management requires skepticism, diversification, strong controls, and preparation for extreme but plausible market disruptions.